I think the next big challenge for the energy transition as a whole is to build out grids. I think the grids as we know them have been built with a view of conventional and more, base load generation in a more centralized way. And we're now rapidly moving towards more distributed and intermittent generation. This poses significant challenges to grids. And I think grids will have to be expanded, reinforced, modernized. More interconnections will have to be built, and this will require huge amounts of investment and will also take actually a lot of time.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. My name is Lisa Langer and I'm leading Aurora's Berlin-based business development team for Central Europe. My guest on the show today is Christoph Strasser, co-CEO of Pacifico Renewables Yield. He is probably one of the youngest guests on Energy Unplugged, but nevertheless not short on impressive achievements. Christoph holds a degree in business administration from University of Mannheim and a master's degree in management from University of Mannheim and ESSEC Business School. Since 2019, he has been building and leading Pacifico Renewables Yield, a stock-listed independent power producer with a quickly growing portfolio of roughly 170 megawatts and priority access to a pipeline of more than 3 gigawatts. Prior to that, he has spent a few years working at JP Morgan's corporate and investment bank. Christoph, thank you for being here with me today.
Pleasure to be here. Thank you.
To start with, you have met Pacifico's co-CEO Martin Siddiqui in your previous job at JP Morgan. I am imagining two bankers sitting next to each other in an anonymous open space in Frankfurt, working late hours, and it is on one of those nights when the idea of Pacifico is born. I'm probably romanticizing a bit, but can you share with us the idea behind Pacifico Renewables Yield and how it turned from idea to reality?
Yeah, sure. I'm very happy to. We were working together closely for a couple of years, and there were a few long nights, as you described. But how it actually happened, for me, is when I joined JP Morgan, the Frankfurt office in 2015 for the first time. It was actually an exciting time because it was basically in the middle of the reshuffling of the German utility industry following the decision to phase out nuclear. And, that's how I got more and more into, the energy sector and also, got excited about renewables. And of course, Martin knew about this. And one day he approached me and said, "Hey, I met this project developer in Munich, Pacifico Energy Partners. They are looking for growth, financing, and growth options. If I want to take a look at this." And so I was super excited, and we started to meet them and understood early on that they had an operational portfolio, and we were thinking about separating this operational business from the development business. And that's when we came in and took over basically the operational portfolio. Listed it early on in 2019, and that's how it started. The idea of our business model, I think, is also described by this background, is that we believe that the efficient separation of risks helps accelerate the energy transition by driving down cost of capital. So I think that's really the core of our approach and how we started in 2019. And it's maybe a bit abstract. So let me try to make it a bit more tangible, what we mean by that. So in the life cycle of renewable energy plants, there are basically two phases. On the one hand side, there's the development phase, and on the other hand, the operational phase. And during the development phase, a project is exposed to what I think is very hard to predict, or binary risks, or can be described this way. For instance, if a project doesn't obtain a construction permit, it might become worthless. On the other hand, the operational phase is characterized by more stable and much more predictable profile. and is exposed to very different risks, such as weather variability. And at the point where those risk profiles change significantly is kind of at the beginning of the construction phase, when most unpredictability has been absorbed or shifted to contractors, and projects become much more easier to monitor and manage. And our approach is that we kind of, with our operational profile as with our company, start investing at the point when plants are construction ready, and keep it very separate from the development activities. So this kind of separation of risks is on the one hand side, I think, core of our approach, and on the other hand, we try to combine skills, working together through partnerships closely with developers, and thereby combining skills and experience in an efficient way, which overall should help give investors a clear profile, and allow an efficient approach, which we hope to drive down costs of capital eventually, and help us realize more projects and accelerate the energy transition.
Excellent, thank you. Yeah, really, really interesting. Talking in more detail about the business model, what is special about the yield co-model that you even have in your name, and that you chose for Pacifico compared to other renewables investment firms?
Yeah, we were certainly inspired what happened or what started in around 2014 in the US with big yield cos emerging. And back then it was mostly driven by large spin-offs of operational portfolios from large developers or independent power producers. And we were convinced actually that this setup with clear risk profiles brings advantages also for smaller companies. And that's why we started with a small company together with a partnership with a small developer back in 2019. And then really quickly, actually, we realized through conversations with other developers that our approach actually also brings advantages for other developers. And that's kind of when the idea was born to more develop into a platform for many small, medium-sized developers to capital markets, because small developers often have, maybe do a very good job but have, small companies typically have difficulties accessing, full capital markets. And we thought it can be kind of the link in between. And it felt like a natural evolution also of our business model, because here in Europe, particularly, the market is much more fragmented, and you see a lot of, small projects, smaller developers realizing those small projects because, there's just, less, the population density is higher, less large tracts are available. So yeah, it felt natural for us to kind of also enable basically small companies to get access to efficient funding. And I think it's an important part of the energy transition to allow small developers, work with, their local ties, be connected in communities, and have entrepreneurial freedom rather than consolidating everything in a group. We think of, our approach is more like partnerships and giving entrepreneurial freedom to small developers rather than consolidating.
That's a great idea, and it seems to be working. Seeing your new partnership announcements over the last few months with Boom Power in the UK, for example, or Ace Power in Australia. This also brings me to my next question. As you said, you partner mainly with small or medium-sized developers, and ticket sizes are subsequently also comparatively small, so ranging from a few megawatts to around 50 megawatts in your recent and biggest transaction in Poland. How do you manage to balance the effort that goes into the entire acquisition, due diligence and financing process with these smaller project sizes? I mean, these are project sizes that many larger investment firms would not consider due to their cost structure. So how can you handle those?
Yes, a key point is that we tried to establish standardized and pre-aligned M&A processes with our partnerships, because they're, we pursue long-term perspective and, target repeat transactions. So that makes things happen more efficiently, helps us build routines, processes, and, allows us smaller transactions to be done, efficiently. And I think this is also a big advantage for the developer, right? Because if you think about a big auction process or an M&A transaction, this is actually quite a time-consuming process, and also takes a lot of resources on the developer side. And we also tried with our approach to limit this and also enable developers to focus more actually on project development rather than sell-side processes. And then I think another point to highlight is I think that we have an amazing team of highly talented and passionate people who I think work efficiently with we try to combine digital tools as much as possible in our processes. But clearly, I think that the main point is that we have young and passionate team that really wants to drive forward the energy transition. And therefore, we can bring kind of what we think as highly professional standards, like a big institutional investor, to smaller plants. That's our ambition at least.
Yeah, great team makes a great difference, of course, and thinking the processes from early on probably also helps. Moving on from your business model, let's talk about what has probably kept you busy for the last few months, and that is Pacifico's market expansion, which you have been driving at an enormous pace. Until recently, the largest share of your portfolio has been in Germany, with a few megawatt projects in Italy and the Czech Republic. And then just in this year, you entered the UK market with the Boom Power partnership, acquired 52 megawatt wind park in Poland, 25 megawatt in the Netherlands, and entered a partnership with Ace Power in Australia, which secured you access to a 1 gigawatt pipeline. So from Germany to the UK, Netherlands, and Australia, what is the rationale behind the expansion? Why did you choose these markets?
Yeah, it's true. It's been an exciting ride during the last months for us, and entering new markets and kind of growing quickly, I think, has a strategic component for us. So we think that increasing size and diversification is important to ultimately gain access to more attractive and more diverse financing sources. I think that's a key part of our business model in the end, is the ability to raise also more holding level debt based on a diversified portfolio. We're now seeing the subsidies becoming less important, and in the post-subsidy world, I'm convinced that different debt approaches will be more feasible, and we try to kind of subsidize or substitute maybe less project level debt with more holding level debt, because a 20-year feed-in tariff in Germany might give you a lot of debt capacity on an individual project level. It might be different for a project where you get a 5-year PPA maybe in the future. And we think that on a consolidated, big, diversified portfolio, you can raise debt efficiently in the future. At the other point, why we chose those markets like the UK or Australia is really linked to the partnerships we've made. We were very fortunate to meet those, I think, amazing small development companies with actually an impressive track record. And that led us to those entering those new markets. Generally speaking, actually, if you think about Poland or Australia, those markets we've been looking at now, is one thing to note that those countries are more at the beginning of their energy transition. Australia, for instance, is the second most CO2 intense economy in the G20 on a GDP per capita basis, and they're facing increasing pressure to decarbonize. And I think with this kind of pressure or decarbonization need, a lot of opportunities will come, and we like to take a long-term perspective, and that's why we're excited about that. And I think maybe another interesting point is these countries more at the beginning of the energy transition. Of course, with less renewables in the grid, you see less of a cannibalization effect, or this might happen later on. So it's from a kind of investment perspective also an important consideration what we liked about those markets.
Interesting. We hear from many investors we work with that they are looking at the next frontier of renewables investment, as returns for subsidized projects in established markets are too low in light of high prices of these projects. And this is why we see investors increasingly willing to take on merchant risk, also as you mentioned, or move to more exotic or let's say less established markets. For example, we work with clients across all of Europe and see a considerable interest in Southeastern Europe now, Greece, Romania, Hungary, something that wasn't the case a few years ago. So I'd be interested to know how you think about moving to less established markets, and on the one hand, and then also on taking on merchant exposure in your projects increasingly.
Yeah, I think less established markets do have interesting aspects. Like I said before, countries at the beginning of the energy transition, I think, can bring a lot of opportunities. And so, yeah, we're definitely also looking at those countries. But for us, it's always important that the whole risk-return profile makes sense together. That's why we've done a couple of transactions in, let's say, more boring or established markets, like in Germany, for instance. Also, kind of again bringing in this portfolio perspective to have a healthy mix. So yeah, that's how we think about it. And thinking about taking on merchant exposure in the future, I think that's a really important question and an interesting one. A bit of a philosophical one also, I think. When you think about it, if should it be the companies themselves or investors via their portfolios who manage risks such as merchant exposure? Probably there's no straight answer to this question, but it's interesting to think about it this way maybe. So why should a renewable stock eventually move with electricity prices, just like an oil stock moves with oil prices? I think this question maybe was less important in the past, at least in Europe, with a lot of subsidies in place. And now when we're moving more away into the post-subsidy world and more unsubsidized projects are being realized that are all seeking long-term power price hedging, this becomes increasingly important to think about, I think. And I think one thing to note or an observation is actually interesting to think about, the supply of new green electricity projects that seek really long-term price fixing. If this decreases and increases more over the time, and the demand from off-takers to buy electricity at fixed prices doesn't increase as much, the cost to hedge long-term power prices could increase, or I think will increase in the future, and that could lead to the conclusion that taking on more power price exposure is feasible or better from a risk-return perspective. So yeah, I think we at the beginning now we were in this strong growth phase. We focused more on stable and predictable cash flows, a lot of contracting to increase the debt capacity and kind of keep our equity requirement low, because it's a scarce resource when we grow quickly like we did now in the last months. But in the future, I think many independent power producers will take on more and more merchant exposure.
Yeah, there's probably no way around it once the subsidy level drops globally. Okay, against this backdrop of taking on increased merchant exposure, I'd briefly like to touch upon what is very close to our hearts at Aurora, and that is fundamental power market modeling. As Pacifico and Aurora, we work together on market analytics and forecasts. And can you share with us how you use those at Pacifico, and how is this changing with more market risks in the projects?
Yeah, happy to. I mean, power market intelligence and forecasts have been extremely useful for us, particularly as we were growing rapidly and looked at many new markets. External expertise was tremendously helpful in order to get up to speed quickly about new markets and focus on the most relevant topics. So we of course use forecasts, for banking processes, but also for our own investment decisions. We take forecasts for important countries, also from several external providers. We compare them amongst each other, look at different scenarios, sensitivity analysis. We look at PPA prices and kind of market signals as much as they're available, like futures. But what's important for us is to always look at kind of ranges and scenarios. Similarly, how we think about hurdle rates, it's not like a point estimate for us. And in the end, it needs to work together. Like maybe a more aggressive power price assumption or forecast might require a higher discount rate, and the combination of the discount rate and for power price forecast together should make sense. And that's how we use it. If it changes in the future with more merchant exposure, of course, yes, this becomes more important for the investment case. But the general approach will be that external views and analysis will I think stay a key part of also our own internal investment decision. But in the end, of course, we need to get to our own view, and that's why we try to take as many data points into account as we can.
Of course, yeah. Moving on to a slightly different topic, a topic that can hardly be avoided, I think, in the energy industry over the last few weeks or months, is the power price surge. We have seen power prices reach unprecedented heights, driven by commodity prices, to a large extent by gas prices. How does this affect renewables investments in general, and how does it affect your work at Pacifico in particular? Maybe start with the short term and then look at the longer term.
In the short term, we have now a few projects that benefit a lot from power prices. So we have a bit of merchant exposure, or significant merchant exposure. That's positive, very positive for us. I think a key point for us we noted is that, in parallel also cost for components increased, actually also quite significantly. So it's actually quite useful that for some projects that, we have higher electricity prices to also compensate for higher module prices, for instance, in the solar space, and allow projects to, be continued rather than, maybe being discontinued or delayed. So I think that's an impact we're seeing in the short term. In the long term, it's probably harder to say, but I think, or I hope that there's increased awareness now for power price risks, and that this will stay in the long term and will lead to, more and more people or energy consumers or off-takers want to fix prices, and this could help, develop PPA markets in Europe, for instance. And, I hope that this increased awareness helps to get a more liquid market, actually, than what we're seeing now.
Interesting. Just thinking about renewable PPAs. What we've seen and heard is that renewable PPA price offers really jumped from Q2 to Q3 this year. We're at the number of almost 10% for competitive PPAs with a tenor of 10 to 15 years. This is, of course, a considerable change, given that I think many in the industry believe in, and so do we at Aurora, that the price drivers are rather short to medium term right now, rather than fundamental long-term drivers. Like the high gas demand currently, the weather effect beginning of the year, and then the low gas stocks struggling to recover. So do you think those higher PPA prices will stay for longer? Is it that increased awareness of risk, or do you also expect that the PPA prices will go down again?
It's hard to say. Definitely. Also in the long-term PPA prices increased, but we are also seeing generally more volatility and prices changing a lot. So generally the risk sentiment has changed, which I think can be a fundamental shift and can stay long term, which would be beneficial to us. So I hope it has has long term implications as well.
This probably also shows the value of relying at least partly on fundamental price forecasting and PPA valuations, rather than only on current market prices and futures, as that would reduce or prevent the volatility or valuation swings, such as the ones we have seen now. Okay, let's move to a broader question on the energy transition, as renewables development is obviously only one part of the solution. And I know you are also thinking beyond that at Pacifico. What do you consider the next challenge of the energy transition?
I think the next big challenge for the energy transition as a whole is to build out grids. I think the grids, as we know them, have been built with a view of conventional and more, base load generation in a more centralized way, and we're now, rapidly moving towards more distributed and intermittent generation, and this poses significant challenges to grids. And I think grids will have to be expanded, reinforced, modernized. More interconnections will have to be built. And this will require huge amounts of investment and will also take actually a lot of time. But actually, there are not enough investments being made, at least what we're seeing in the last 4 years. Investments into global grid infrastructure have declined 4 years in a row now, according to the IEA. So that's actually quite striking. And it will not only take a lot of investments, but also will actually take time. Building our grids, are complex matters and projects, and I think this will happen more slowly than the build out of renewables. And this really, opens a big gap to fill. I think where other technologies will have to come in to help stabilize the grid. And I think a very important technology for this will be battery storage. And that's why we're excited about entering the battery storage market. We believe like the technology, lithium-ion batteries are, can react quickly and are actually a technology, a well-established technology, which is known since or existed since the 1970s, and now due to the falling costs of batteries, due to the expansion of e-mobility, now it makes also economic sense to use it at grid level applications. And this will play an important role for the energy transition. I'm convinced about that. And also from a strategic perspective, we like batteries as a complementary technology for our portfolio. Because, if you think about one risk we're exposed to as a producer from solar and wind power is the cannibalization effect, right? And when you think about, more and more renewables being built out, and the more renewables you have in the grid, the more cannibalization you will see. And batteries, on the other hand, actually might benefit from the build out of more renewables, because price volatility might increase, and batteries can be used not only to provide grid stability services to the grid operator, but also can be used to trade electricity basically by charging when prices are low and discharging when prices are high. So for us, it feels like a bit of a natural hedge almost in comparison or in addition to our other assets.
I'd be interested to hear what are the markets you're looking at for batteries, because of course, especially revenue stacking, as you've mentioned, for batteries really depends a lot on market design. So is it that you are focusing for now only, for example, on the UK, where that is already possible to a larger extent than for example in Germany, or what do you have any country focus for batteries at that stage? Maybe it's too early to tell.
No, we're clearly focusing on the UK. As I think a very interesting market now in the short term, but also Australia. I think with our cooperation with Ace Power, we're also starting to look at batteries in Australia, and I think batteries particularly make sense in only in certain markets or special markets at the moment. I think the UK is, of course, is special because it's an island. So far, it has relatively limited interconnection and has already a lot of renewables in the grid. That leads, I think, to the more need for stabilizing the grid. And other markets, so like Australia, which also actually has some grid issues or grid constraints already now. You see more and more batteries being built. So these are the markets we're looking at now, but I think it's a bit of foreshadowing what about the issues and problems other markets will be facing in the future as well. So we're very happy to be now active in those markets, and then hopefully also move to other areas. I think in the US, for instance, you're also seeing actually a big increase of build-out of grid-scale batteries happening already now. So yeah, I think this will be an important topic, not only in a few markets, but more and more markets over time.
Yeah, it's probably all those markets where we already now have more locational incentives for generation and demand. Great. I would like to end this show now with a very brief version of Overrated or Underrated. That is a popular way of ending the Energy Unplugged podcast. I give you a keyword or a concept relevant to what we've talked about, and Christoph, you answer in a single sentence whether you think this is overrated or underrated in the current debate in the energy industry. So first, corporate PPAs as a means to push renewables build out. Overrated or underrated?
Yeah, so building on what we've discussed before, probably a bit overrated, because there, I think, can be other means of managing those merchant risks, but they will play an important role, but people, I think, are aware of that. So maybe a slightly overrated.
Okay. Second, ESG criteria in renewables investing in general and the EU taxonomy in particular. Overrated or underrated?
So I think ESG in general, I think this is it's a very popular topic. The EU taxonomy less so. So I think maybe just speaking about the EU taxonomy specifically, this is, I think, clearly underrated for now. We've been now, for instance, on recent transactions assessing the EU taxonomy compliance of our plants, and we've actually seen that there are different takes on how to implement the taxonomy, and there's actually limited awareness. So I think the taxonomy for now, at least for power producers or companies like us, might be slightly underrated.
Interesting. Good. Then last but not least, the role of hydrogen in decarbonizing the economy.
I think topic many people talk about a lot, but in the short term, I think it's overrated. Hydrogen is just has a lower round trip efficiency compared to other technologies. We spoke about batteries. We like batteries, so at least in the short term, I think there are more cost-competitive applications for many sectors than hydrogen.
Okay, Christoph, it was a pleasure speaking to you. Thank you for taking the time today.
Pleasure was all mine. Thanks for having me.
That was Lisa Langer, Commercial Manager at Aurora, talking to Christoph Strasser, Co-CEO of Pacifico Renewables Yield. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.